Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate filings so you don't have to. Today we are diving into a Form 8K filing, which is basically the corporate version of a breaking news alert. Get ready because this report is about a company making some big moves with its money. We are looking at a filing from Rollins Incorporated from March of 2025. Rollins is a pest control company. Think Orkin, that's them. They are changing some things with how they borrow money. It is not unexpected, but it could have some effects down the line. First up, Rollins is launching a commercial paper program. Think of it like a corporate credit card. This lets them borrow money for a short period, like for day-to-day expenses or to cover a sudden cost. They can borrow, repay, and then borrow again as needed. The important part, they can borrow up to $1 billion. These notes or short-term loans have to be paid back in less than 390 they get from this program will be used for general business needs. That means it could be anything from buying new equipment to expanding their services. It's like having a flexible line of credit to keep the business running smoothly. To make this happen, they're working with commercial paper dealers. These dealers will help Rollins sell these notes to investors. It is like having a middleman to find buyers for their short-term debt. Basically, they are hiring people to handle the selling of these notes with some rules for the hiring. Now, let's talk about their credit agreement. They have made some changes to it. This is like rewriting some of the rules of their existing loan agreement. The big change, they're releasing some of their subsidiaries or smaller companies they own from guaranteeing the loan. Previously, if Rollins couldn't pay, these subsidiaries would have to step in, but now they're off the hook. Now, none of Rollins' smaller companies are guaranteeing the loan. This could mean Rollins is confident they can repay the loan themselves. They also made a similar change to another agreement called the indenture. Again, they're releasing some of their subsidiaries from guaranteeing the debt. Same situation here, no smaller companies are on the hook anymore. All this borrowing falls under the creation of financial obligations. They are taking on new debt and making changes to existing debt agreements. It changes how the company is funded. Now let's look at the exhibits. These are the actual documents that spell out all the details of these agreements. You can dig into these to see the exact terms and conditions. There's the first supplemental indenture, which details the release of the subsidiaries from the debt guarantee. Then there's the form of the commercial paper dealer agreement. This shows the agreement between Rollins and the dealers who will be selling their short-term notes. And finally, there is amendment number 1 to the credit agreement, which describes all the changes to the loan agreement. Now, what does all this mean for Rollins? Well, on one hand, they now have more flexibility in how they borrow money with the commercial paper program. That billion-dollar line of credit will let the company grow. On the other hand, they're taking on more debt and they're removing some of the safety nets that were in place with the subsidiary guarantees. This could be a sign that Rollins is confident in its ability to manage its finances. It could also be a risk as they are now more directly responsible for repaying these debts. It is difficult to say at face value if these were good decisions. It depends on their growth projections and interest payments. Overall, Rollins is making some strategic moves to manage its debt and fund its operations. Whether these moves pay off remains to be seen, but it's definitely something to keep an eye on if you're following the company. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives. Let me know what company you want me to look at next.